this down close candle is a bullish order block. We traded down to it last week, and then today we opened, we traded down to it once more, and then they capitalized that discount level here, which is the opening price of that down close candle, and then sent it back above the rejection block here, okay, which is the highest up close candle. Now we have this wick to contend with. Now, I was going to draw out where the consequent encroachment level is, but it's essentially look at the same level as this high here because it's close proximity to that. So it's going to afford me the luxury of saying I'm watching price to see if it can get to this level in here. All right, so here's the 15-minute time frame. This is a bellwether chart. That means it's one of those go-to charts where it gives you most of everything I would ever need and not even require looking at a daily chart or a 4-hour chart or an hourly chart. So this blue line here is that daily bullish fair value gap. You can see we dove down into that here last week, and we came back off of it, dropped back down once more here today in London, and then we consolidated around in here, traded back above, came back in, had a little bit of a stop raid here, rallied up, and took out the buy side here and this buy side there. But on the 15-minute time frame, I was teaching this week how you can very easily look at two close proximity 15-minute fair value gaps. And those 6 levels being the high, the consequent encroachment or midpoint of it, and the low of 2 specific 15-minute fair value gaps. Now, which one is that? Well, where's the most recent one that's formed? And what's the one that formed prior to that? Just looking back, that's all you're doing. And then you use that as a canvas to study price action. So it gives you a context to go in and start studying. Now, what happens when the price runs away and leaves both of them? Then you start looking for the next 15-minute fair value gap. And you keep doing this continuously. So you're always having a dynamic range or canvas to study price action. I mentioned this one here. Now, why did I mention this one? This is basically anchored right to the daily bullish fair value gap. See that? So that blue line here, it intersects with that fair value gap right there. And then since I was looking at price action pre-session, towards the end of London Open, we were inside of that. So now look back in time on the 15-minute time frame. This is the one that I chose. Was important. Why? Because it was inside the high of that drop down that was a raid, taking out sell side, which makes this what? A bullish breaker. Oh, ooh, epiphany. See how that works? So when we look at the imbalance in here, that 15-minute time frame, we can start looking at the relationships between these two. Just know that this high is the first green level, and this here is the next buy side liquidity pool. So make reference to those numbers here, those price levels. That way it's understood what it's reaching for. All right, let's zoom in here. All right, same thing, 15-minute time frame. And we're looking at it with the drop down below this heavy thick line. I thickened it up. That's the daily bullish fair value gap. And we drove down into that there. And then we started consolidating inside that 15-minute buy side imbalance, sell side efficiency. And I added the gradient levels of 75 and 25%. So that way it kind of gives you a little bit more fine tuning of the opportunities that could be afforded to you as a scalper or someone that's looking for pyramiding entries that if you want to tape read or demo trade to build the affinity for that. But we reach up into the buy side here and we do it here as well. But look at the reaction off of that one right there. That fair value gap is high. And look how much time it spends inside hitting the key levels. So we're zooming in again. So this raid on sell side, we drop back down in, and right there, we hammer the low of the 15-minute fair value gap. We rally up, trading into the other 15-minute fair value gap, which is, again, anchored to a PD array in and of itself. So see what we're doing? We're blending a confluence of PD arrays. We're not just looking at any one individual candlestick or PD array or focus point. We're blending a few of them. Now, if you recall, I counseled you to try to avoid trying to pick a top in the NQ. So if we see a low, high, lower low, as we have here, bullish breaker, this is going to be salient. This is going to be worthwhile if we start studying this. And inside that, going to the left, we see there's a fair value gap right there in the form of a SIBI. So this is going to act as an inversion fair value gap at a later time. So as we go closer to the 9:30 opening and the opening range, we can anticipate a likelihood of the market wanting to rally back above it and then use that as a catalyst to send it higher. So right away, 1 minute chart, you can see how we were below that. So before 6 o'clock in the morning, Stops were rated. We traded back up inside of it. This heavier blue line, it's eventually going to go away, and you'll see that consequent encroachment level that's thinner just above it. That will remain in the chart. But just know that we traded down into the low of the fair value gap there. We consolidated, accumulated around the consequent encroachment of that fair value gap that's noted here. Then we traded above it, hit the high, and then gravitated towards that higher 15-minute fair value gap. Worked its high here, taking out this high rather, and then we worked down below it, meandering around. We want to study how price sweeps above it and below it. And once there's a sweeping effect, then it goes right back into using it again. Sweep below it, upset any liquidity below here, get back into it, use it as low, and then where are we looking for it to trade to? Higher, because we're trying to avoid what? Picking a top in the NQ. And it rallies up. Where is it rallying? Taking out highs here, okay? So again, we drop back down into it there. It rallies back up, comes back down in, pyramid, rally up. And then when we opened up here in the opening range, they sink it all the way down to take out the sell side right below these lows inside that fair value gap, down to the high of the first fair value gap I showed you to pay attention to today. Not first presented fair value gap, the first one I outlined in discussion in that video. So here, this is what I kind of want you to think about. Here's how many high frequency trading setups were based on just these two fair value gaps, okay? We went below it. I told you that we would see that drop down to take the liquidity, and then it rallies up, comes back down once more. Low of the day. Here's entry from here to here, this level here to that level here. That's one setup. Another one is here, using the high of this fair value gap, up to the low of this fair value gap. That's a price run. How many trades is that? 2 already in a span of a very short period of time. Less than a half an hour or so, you already got 2 trades on. Or you could have been using it as a long, partial, or pyramid for continuation to that one. And then we have the turtle soup, which I showed myself trading, run this high here, and we'll use a draw back into that second fair value gap on the 15-minute time frame that I outlined, which is the higher of the 2. So that was a short. You watched me literally do that on X today. And then going long here to do another run up to take out that high, using the high of the fair value gap, it's in red, to run buy side. So entry here, exit here. So A is entry, B is exit. So that way you're following along in the chart. Same thing here, going long here, taking out the buy stops above that high here. So that's another trade using this simple fair value gap idea. And you keep walking forward. Every time the 15-minute chart creates a new fair value gap, you just add that on to the previous fair value gap that you were using in the series throughout the day. See how dynamic that range becomes? And you don't forget the other one. You know, like for instance, this one here. Say a 15-minute fair value gap formed above this one, like up in here. Well, then you'd use this one and whatever that one was. And then this one you'd still have in your chart, but you would just work with the 2 most recent ones. And you're constantly reading order flow in relationship to those 2 15-minute fair value gaps. Dropping down into this here, just remember this price return to 21,237. We'll move forward. That's here. Okay. So we can see using the first percent fair value gap, we can see a short here in first percent fair value gap down to this level. So entry to target, or target here. New entry here using the higher fair value gap from the 15-minute time frame up to first percent fair value gap, low, that shaded green box, okay? So that's a trade there. Entering here inside of Friday's first percent fair value gap in the gray, trading that up into this run up here, taking that liquidity out. You had to sit through all this time distortion, and you can pyramid here, you can pyramid here, and then finally getting out there.